As of the market close on Wednesday, November 26, 2025, Tilray Brands, Inc. is trading at exactly $1.03 per share. The stock managed to claw its way up by roughly 4.7% during the regular session, closing up nearly 5 cents. However, if you are looking at that green number and feeling a sense of relief, you are looking at a mirage. The true story, the violent, capital-destroying reality, is unfolding right now in the after-hours market, where the stock has plummeted to 86 cents. We are seeing a massive double-digit drop that has effectively erased the day's gains and then some. That price of 86 cents is not just a number, it is a siren blaring a warning to every single retail investor holding this bag. The market is currently closed for the Thanksgiving holiday, but when the opening bell rings on Friday, we are likely going to see a bloodbath that will test the resolve of even the most diamond-handed believers. The expectation for Tilray Brands has always been one of grand, almost intoxicating optimism. The narrative sold to the public is that this is the Amazon of cannabis, a global juggernaut waiting for the United States federal government to flip the legalization switch. Investors look at the ticker, TLRY, and see a lottery ticket. They expect that any day now the DEA will reschedule cannabis, the SAFE Banking Act will pass, and Tilray will rocket back to its meme stock glory days of $20 or $30 a share. They see the acquisition of craft beer brands like Sweetwater and Montauk as a genius diversification play, a way to insulate the company from the regulatory gridlock of the pot market. The belief is that Tilray is playing 4D chess while everyone else is playing checkers, building a massive distribution network that will one day flood the country with THC-infused drinks the moment the legislative floodgates open. But the reality is that Tilray Brands is currently fighting for its life against a mathematical tidal wave that has nothing to do with weed and everything to do with financial survival. The immediate catalyst for this after-hours crash to 86 cents is the widespread fear and market chatter surrounding a potential reverse stock split to maintain listing compliance. This is the reality that shatters the expectation. A reverse split is rarely a sign of strength. It is almost always a desperate maneuver to remain compliant with Nasdaq listing rules and to artificially inflate the share price to make it look investable to institutions who are barred from buying penny stocks. By slashing the share count and boosting the price, they aren't creating value, they are simply rearranging the deck chairs on a ship that has been taking on water for 3 years. The tension between the growth story investors want to believe and the financial engineering the company is forced to execute is where the danger lies. Let's analyze this potential movement because it is the single most important event for the stock right now. When a company trades near the $1 mark for an extended period, they are effectively admitting that the organic buying pressure is not enough to keep the stock above the compliance threshold. For the retail investor holding 1,000 shares at an average cost of $5, a reverse split doesn't change the value of your holding mathematically, but psychologically it is devastating. It highlights just how much equity has been incinerated. Furthermore, reverse splits often act as a beacon for short sellers. Predatory algorithms know that companies who reverse split often continue to drift lower post-split. They smell blood. The drop to 86 cents in the after hours is the market pricing in this fear, the fear that the new higher stock price will just be a fresh target for shorts to attack all the way back down. But the bearish reality goes deeper than just the share structure. We have to talk about the Trojan horse strategy that was supposed to save the company, the alcohol division. The expectation was that by buying up struggling craft breweries, Tilray could build a cash-flowing engine to support its unprofitable cannabis operations. On paper, it makes sense. Beer is legal. Beer flows cash. However, the reality is that the craft beer market in the United States is currently facing its own existential crisis. Consumption habits are shifting. Gen Z is drinking less alcohol. The craft beer boom of the 2010s has turned into a saturation bust. Tilray is acquiring these brands, Shock Top, Breckenridge, 10 Barrel, at a time when the sector is contracting. They are effectively becoming a collector of distressed assets in a declining industry. While this boosts top-line revenue, making the growth look good on a shallow pass, it comes with significant baggage. Margins in the beer business are under pressure from rising aluminum costs, rising labor costs, and the sheer competitive density of the shelf space. And then there is the Trojan horse strategy that was supposed to save the company, the alcohol division. The expectation was that by buying up struggling craft breweries, Tilray could build a cash-flowing engine to support its unprofitable cannabis operations. On paper, it makes sense. Beer is legal. Beer flows cash. However, the reality is that the craft beer market in the United States is currently facing its own existential crisis. Consumption habits are shifting. Gen Z is drinking less alcohol. The craft beer boom of the 2010s has turned into a saturation bust. Tilray is acquiring these brands, Shock Top, Breckenridge, 10 Barrel, at a time when the sector is contracting. They are effectively becoming a collector of distressed assets in a declining industry. While this boosts top-line revenue, making the growth look good on a shallow pass, it comes with significant baggage. Margins in the beer business are under pressure from rising aluminum costs, rising labor costs, and the sheer competitive density of the shelf space. And then there is the hemp apocalypse that is quietly brewing in Washington, a threat that almost nobody in the retail chat rooms is discussing. Tilray has leaned heavily into the hemp-derived Delta-9 beverage market. These are the drinks that get you high, but are technically legal under the 2018 Farm Bill because they are derived from hemp, not marijuana. This has been a massive growth loophole. But the reality is that Congress is currently looking to close this loophole with a new legislative framework that could effectively ban these products or subject them to the same draconian restrictions as actual cannabis. If this legislation passes, and there is bipartisan support for it from both anti-drug conservatives and pro-cannabis progressives who want a unified regulatory framework, Tilray's THC beverage growth thesis hits a brick wall. The market is just now waking up to this regulatory risk. The expectation was that the beverage market was the safe route. The reality is that it might be the next regulatory casualty. Let's look at the recent financials because the numbers tell a story of running to stand still. Tilray reported net revenue of around $200 million for the recent quarter. That sounds like a big number. But when you look at the bottom line, the net income is still elusive in a meaningful, sustained way. They are posting massive impairment charges. We are talking billions of dollars in write-downs over the last fiscal year. This is essentially the company admitting that the assets they bought in the past, like the Afria merger assets or the Hexo acquisition, are worth significantly less than what they paid for them. This kitchen sinking of the balance sheet is painful. It wipes out shareholder equity. When you see a company reporting a net loss of $2 billion in a fiscal year due to impairments, it tells you that capital allocation in the past was disastrously wrong. The current management team, led by Irwin Simon, is trying to clean up this mess, but the hole is incredibly deep. We also need to discuss the German legalization narrative. This was the massive catalyst earlier in 2025. Germany partially legalized cannabis and the stock popped. The expectation was that this would open the floodgates to a European green rush. The reality has been far more bureaucratic and slow. Germany didn't go for a full commercial sale model like Canada or Colorado. They went for a social club and home grow model with a slightly expanded medical market. While Tilray's well-positioned in Germany with its cultivation facility in Neumünster, the revenue explosion hasn't happened yet. The red tape in Europe is thick. It is not a free-for-all. It is a highly regulated, slow-moving medical market that requires immense patience. Investors who bought the Germany pop are now underwater because the revenue ramp is a slow burn, not a fireworks show. This brings us to the topic of institutional ownership, or rather, the lack thereof. The reason Tilray might be forced into a reverse split is to attract big money, the Fidelity Wealth Management Funds, the Vanguard ETFs, the pension funds. These entities often have charters that forbid them from buying stocks trading under $5. By hypothetically reverse splitting to $10 or $12, Tilray is trying to get back on their radar. But here's the catch. Institutions don't just buy a stock because the price is high enough. They buy it because the business is good. They look at return on invested capital, ROIC. They look at free cash flow, FCF. Right now, Tilray's metrics in these areas are still trying to find their footing. If a reverse split happens and the institutional buying doesn't materialize, the stock is left with no support. It becomes a ghost ship drifting on retail sentiment alone. I want to pause here and ask you directly,